welcome to the HistoryMakers equity market discussion. Before we start, I'd like to acknowledge all the UP students that have joined us today. I think if you followed our journey from the beginning, you'll know that one of our biggest objectives has always been to expand into other campuses, and through that strategy, reach out to more young people to engage in this conversation of financial literacy. So today's webinar is one that I'm particularly excited about, considering that I am invested in the equity markets, and that's what I've been doing, with my spare time, working from home. And I know that a lot of you as well are also excited about this. So being a person who's in a community of young investors, I think we've seen some really extreme results. I have friends who've made 200% returns in just the space of 6 months, and some friends who've made, who've lost almost all their initial investments in just the same period. So it's been a period of extreme fluctuations in the equity market, and I feel that such fluctuations can cause a lot of confusion, and it makes us vulnerable to make serious losses, and makes us vulnerable to make serious mistakes, and also bad assumptions about what investments is about, because I've noticed so many people are looking into the price instead of the actual company itself, because they're just wanting to jump into the stock that's rising right now. And so we felt it was very important to have this webinar today, because we are in the middle of something that's really, really, really serious. So to help us with this discussion, we have a gentleman who is a portfolio manager and director of an award-winning company. I'm talking about Rand Swiss. He's also a market analyst for a couple of channels, CNBC, SABC3, BusinessDay Tv, and and ETV as well. And he's also a regular market analyst for podcasts like Money Talks on 702. So without wasting any time, let's get him into the conversation. Gary Booysen, how are you doing, sir?
Yeah, very good. Thanks for having me on. It's always good to come and chat to you.
Thank you so much for your time, sir. The floor is all yours. Take it away.
Okay, I'm gonna try and so like I was saying, for the guys that have just jumped on now, I'm gonna share my screen. I've got some slides for this as well. So I'm just gonna put them up. Just shout if you can't see them. I'm gonna try and share now. So okay, share that. Okay, can everyone see that? Is everyone is that all good? Let's just get the chats up.
Yeah.
You can see everything good.
Yeah, I think
okay, cool. Yeah. Sorry.
I think it's visible. Yeah.
Okay, it's visible. Okay, cool. Yeah, and like I was saying earlier, I mean, if you guys want to stop and interrupt me and ask questions, please do that, because it's boring. If it's just going to be a YouTube video, you can go and watch that online. It's like live. So so the whole idea is that if you want to make it interactive, that's probably the most exciting stuff. Okay, so we're going to talk. So it's an equity market discussion. So I just want to move this so I can actually see the screen. Okay, so yeah, so this was kind of my brief. So it was quite a broad brief. I'm going to talk about shares and investments in pandemic, and I think I stretched the brief a little bit as well. So I'm going to kind of take you through a lot of different things. But first, I just want to take you through a bit of the background of our company and where I'm coming from, so that you've got a little bit of a sense of where I've come from and how I look at equity markets, and kind of the preconceptions that I might come with. So obviously, okay, so Rand Swiss, obviously we had a wonderful introduction. Yeah, we work with a whole lot of different media partners. We work with a lot of the international banks, a lot of the local banks as well. Obviously, we sit, this is for the guys that missed it, I was showing kind of the JSE lobby. So right behind us here is the lobby of the JSE. This is one of the JSE boardrooms. We work in the exchange building. But JSE is only really one of our suppliers. So we trade, obviously, local markets. I mean, we do derivative trading on local markets. We do equity, standard local equity portfolios. And we do all of these kind of services down the side, from online trading, which is, it's normally levered. It's quite short term, and it's very much focused on the client making the action. To that advisory stockbroking, which is literally our dealers sitting with private clients and working through their portfolios. Then I manage a portfolio as well. So that's where the portfolio manager part of my title comes from. And there, I've managed that portfolio so it's based on a strategy that we ran probably for the last 10 years or so. no, but maybe just longer now, probably about 13 years. But when we started Randsource, I'm going to take you through the history of the company as well. That's kind of where we formally started the portfolio. So it's got a 5-year track record on it. Now, I'll show you some performance stats and kind of some of the thinking behind how we manage money as well. So, either you apply it to your own situation, and it can kind of maybe give you some ideas. We do structured products, offshore transfers. When we talk about all those businesses in time. So basically, we started the company in 2015, and it was very much like a research-based company, and it was advisory stockbroking. So what does that mean? Very different from, like, I suppose, the millennials these days, where you guys are all just online, kind of manage your own share portfolios, log in and do it yourself. I come from kind of the old school stockbroking background, where it was very much relationship driven. You were kind of chatting to your clients on a daily basis about, like, should you be buying MTN here? Should you be selling MTN? And kind of like looking at it very much from an advisory point of view. So when we started the company, that was really the drive. It was like, you have a good, like, personal service offering for your clients that you're chatting to. And then you have a research offering as well, which is obviously you're doing that kind of deep dive research into different companies. In 2016, we kind of expanded. We had to come into the modern age very, very quickly. So we kind of launched the online trading stuff, which is very much like platform driven and system driven, where you essentially take control of the stuff yourself. And as I said, that's where we actually got what's called Cat 2 licensing. So we managed to license our funds. And that's obviously where we can manage on behalf of other clients rather than just giving them stockbroking service. 2017, we added structured products, which is, like, I can talk a little bit about structures. It's probably not going to be applicable to you guys because it's not just pure equity investing. It's more like bond investing, and it basically uses like a derivative overlay to give a client capital protection. So it's like, let's say you've built a position in Capitec, but you want to make sure that you've got 30% downside protection on Capitec, and that you want to basically release some fixed income upside, for example. So you kind of create a derivative structure around a stock position, and then you get like all sorts of weird and wonderful payoff profiles. So it's quite exciting, like when you're dealing with like clients that have very specific requirements. So it's kind of stuff like, I mean, you'll see them go. It's not really a structured product, but the idea would be like those zero cost collars you might see on Sens, when directors want to basically lock in the stock price of Capitec, for example, and they want to release fund. They want to use their shares as a funding mechanism. So that's what structures are about. Right now, we've got some really cool ones, like based on the S&P 500, but it's like you can get, it's like 1.05 times upside. So if the S&P 500 goes up 100%, you get 105%. But if the S&P falls, you get 30% capital protection. So if it finishes a 5-year period down, say 29%, you get all your money back. So it's like kind of these little enhanced structures that we've done. Works really well for private clients. We obviously have an offshore transfer business as well. So we've registered with the Reserve Bank. Which has been a very interesting process. And that kind of facilitates international payments. That took us 3 years. I've always wanted to do that. And that took us basically 3 years to sign off. It was an incredibly difficult application to make, but yeah, that came through. So in 2017, obviously our first business, which was the stockbroking business, we actually, like, there's a award system. It was mentioned earlier as well, but we basically ranked 3rd overall in the country. Behind Standard Bank obviously came number 1. In 2018, we really fleshed out like our retirement planning stuff, which is more like the wealth management arm. And we also brought in tax-free savings accounts, which is kind of like it's a fantastic vehicle to use as for especially for young investors. So I'll talk a little bit about the TFSAs later. There, obviously, 2018 we moved up the ranking. Still Standard Bank as number 1. Absa came 3rd, but we kind of like came in as number 2, which I was obviously very proud of, because we're a little company and we're a startup basically, and they are huge banks that we were competing against. And in 2019 we won overall. So we won the top broker of the year award, top stockbroker. We won best advice broker and the People's Choice Award, and we kind of got ranked overall the top broker in South Africa. And it's quite a complex like analysis that they do on us, from spread of products, the costs, they mystery shop us. We've got to do, like, it's a huge amount of detail to go into. So it's a very robust survey. So we're very happy, and now we're in 2020, and we are currently going to find out in about 3 weeks' time whether we hold our ranking or what happens. which is going to be quite cool as well. So that's kind of where I'm coming from. That's the background of who I am and what we do. So let's talk about equity markets. Let's talk about like what happens in 2020. So yeah, it's been an interesting year. So if I look at it, I used to use this slide a lot in presentations, and the slide literally, it started probably about five years ago. And everyone was concerned about everything, because everyone is always concerned in markets about what you should be doing and if you should be investing, should you be getting involved, shouldn't you be investing. And every year it was like 6-year-old bull market. Everyone is, oh no, it doesn't look great. Things are going a bit wonky. You know, should we be selling out of equity markets? Then it was like 7 years, 8 years, 9 years, and then eventually it was a 10-year bull market. And I think we can finally say that the bull market is dead. 2020 killed the bull market. So Fed is no longer raising interest rates. Fed is cutting interest rates. Like companies, I mean, company profits, we'll talk a little bit about company profits. Commodities have been all over the place. We've had oil trading negative this year. We've had literally people paying you to take oil, to like massively rocketing gold prices. So, I mean, commodities all over the place. Like, I mean, everything is, I mean, it's absolutely been a wild ride in 2020. And it's just a cartoon, yeah. So it's basically like everyone has been saying, you know, this is the top, here's the top, here's the top, and the markets just keep going up. And I think that's one of the things in markets that people always underestimate. And I'm going to show you a chart. So that's basically what's happened. Okay, so that's a slightly longer term chart. Oh, actually, this is the shorter term chart. There's the longer term chart. But that's essentially what's happened in equity markets this year. We've had a horrendous time thanks to coronavirus. And everyone has kind of been waiting for it, because it's weird. Like after 10 years of almost like very, very stable earnings, everyone has been calling it, but they've been calling it for so long that this is the top, there's going to be a crash, you know, that it took something as unprecedented as coronavirus to make people panic, I think. And like I said, it's been absolutely crazy. So you've had kind of like, you had a significant dip. And I mean, these markets that you're seeing here. So I've done S&P and S&P total return. We can talk about that in a bit. I've done the JSE All Share Index and the FTSE 100 as just a couple of markets to have a look at. You can see that the pretty much like the S&P has been the standout performer. The JSE actually hasn't been as bad as everyone says. It's been subdued and people have been very concerned about it. Our market is divided into, you know, our market is not necessarily just local markets. So we can't just look at local or global economies. We've obviously got very specific drivers of our index. So whenever you're looking at an index like this, it's a composite of the companies that are underneath it. So Naspers and Prosus are such a large part of our market. And I think if you look at the top 5, they make up the top 5 companies on the exchange. They make up almost 50% of the move of that index. So if you've got Richemont, Standard Bank, Prosus, and Naspers recovering, the index recovers, even though what you might be feeling in the small and mid-cap space is a lot more dire. You know, those kind of small mid-cap companies in South Africa, and this is something I wasn't planning on talking about today, but we can talk about it. It's a sense that I'm getting anyway in our market that the local market is kind of being hollowed out a little bit. You know, when you look at listed markets like this, essentially what happens is we need young entrepreneurial people to go out and start businesses and to create businesses. And those businesses have to grow in the private equity space. They have to come through from either, you know, private equity funders, angel investors, however they get funding, or just through organic growth if they're that good. And these businesses have to grow and expand to a level where it makes sense for them to list either on the AltX board or list on our exchange. And I think one of the problems in South Africa at the moment has been that I think we've got the entrepreneurs. I don't think we've got the support structures in place enough to support our young entrepreneurs in building businesses that are going to come to our market. And that, I mean, if we compare that to the US, I think is incredibly unfortunate because I think that's where the real excitement in markets happen as well. It's easy to come and buy these big kind of like stable blue chip offshore companies. I mean, you go and buy a Richemont or a Naspers or something like that. It's a huge international company that happens to have listing in our environment. So you go and buy into a company like that. If the rand weakens, it's very linked to the international markets, and that's why you see our index actually does quite well, even though the country potentially does quite badly. Whereas I think some of the small and mid caps, if you strip those out, they've had a very, very tough time of it. And I think we need to see more of those kind of private equity firms. We need to see small and mid cap. How can I put this? We need small entrepreneurial firms to come and list on the exchange. If we get them listing on the exchange, I think it's going to make for a much more exciting local market, personally. At the same time, I think also, the fact that you guys are doing events like this to come and have a look at the local market, I think is absolutely great. Because I think the problem that we're facing now as well is just that, the country's going through a very difficult time. And what that's meaning is that investors are incredibly pessimistic. And I'll talk a little bit about kind of like our client reaction, the kind of client flow that we're seeing. But the problem is we've got also some great small and mid-cap businesses, like really, really solid ones. If you look at the fundamentals on them, they're very low PE. These companies are making, you want to talk about results. We had something like Metrofile coming out the other day. We had, I'm trying to think of the other one that came out the same day. AVI as well. AVI, absolutely not spectacular. Revenue was flat, but given a period like we've had with lockdowns and that, AVI has done exceptionally well for the business that it is. It sells Baker's biscuits and Five Roses tea, in lockdown they could still sell that, but it's also got Spitz, which is a footwear business. They've done really well, but compared to international markets, their PEs are very low. They don't command the investor interest. So it's not that their earnings are rubbish or that they're not able to grow or they haven't got a captive market and they don't have customers. The problem really is that these companies, investors just aren't willing to take the risk of investing on the South African exchange, which I think is incredibly sad, because the problem is you've got these real gems, but you have no catalyst to see like a wall of investment money coming through and actually ramping up the share prices, which is what's so exciting for stock market investors, because you're buying something at a discount and you have a catalyst that then allows you to see the share price move and then realize your profit. And I think that's kind of one of the big problems, and I think that can turn very quickly. And I say it's down to people coming and investment clubs and people all coming together and kind of like becoming interested in the local market again. But I think it's also something that can turn very, very quickly. So, I remember when I was working around the 2008 crash, the biggest thing ever, like if you were international, I remember like dealing with some of our international partners. There was actually a lady from Scotland. And I was like, South African markets, a little bit rocky. We've got the financial crisis. She looked at me, she said, what are you talking about? You guys are you're working in the emerging market. You're working in like the most exciting place on the planet, because this is the place where all the growth is going to come from. This is the place where you've got companies that can still grow. She says, if she was from Scotland but working in London, she says all our businesses are old and there's no scope to kind of grow. And we want to kind of go and capture these economies where there's large populations, the demographics are in their favor, you're getting a lot more people born, you have more customers for these businesses. And at that stage, it was all about going into the BRICS nations. This is talking 10 years ago. You wanted your company to be represented in China to get into the growing middle class. You wanted to come into South Africa because South Africa was seen as, one, the springboard to Africa, but it was also seen as a place that you were going to have this massive upswell of middle class consumers that were going to be able to buy products. And it was a perception in the market at that stage, and that has changed now. So the change that we've seen has been that emerging markets are too risky, that things are very, very nervy, and developed markets have almost become flavor of the month. Over, I'd say, the last, say, five years, that's been the case. And you've seen everyone rushing into Apple and Amazon and Nvidia and Netflix and all the FANG stocks, those big tech companies. And as you moved into these kind of tech-based companies, you people are sort of forgetting about the emerging market. And I think, if you, and again, I'm going to talk about investor profiles in a bit as well. But when it comes down to actually selecting where you're going to invest, if you're a long-term investor buying some of these I think, very undervalued South African companies, if you get a shift in that international sentiment again, that things and it doesn't have to even come from South Africa, it doesn't have to come from policy changes, it doesn't have to come from anything like that. It just comes from the international community suddenly like almost making the decision. And it's a weird thing in markets where the sentiment just turns, and it's got nothing to do with something. I mean, you can have a trigger like something like coronavirus, but you could have something where suddenly the market just decides that they're not willing to pay 150 PE for Amazon anymore because that's too much. And Amazon actually has, I mean, it was a weird story. So I was actually buying something on Amazon the other day. It was a laptop charger for the laptop I'm working on here. And the laptop charger, like, I couldn't get it was a Dell laptop, so I couldn't get the actual charger from Dell. But there were 3 resellers on Amazon, and they had 90% ratings. But I kind of looked at the specs on the back, and the product number didn't quite match. So I did some Googling and some research, and suddenly I realized that, and there was an article on Business Insider. They did an experiment where they took 100 Dell chargers, or not Dell chargers, but they took 100 basically OEM kind of products, and they tested them for fakes. And they found that I think it was 47% of those products sold by Amazons were fake. Like, it wasn't sold by Amazon, but it was Amazon resellers with 90% ratings, and customers were happy, but these were fake products. Now, when you've got something like that, and it's just something like in the back of mind, I mean, Amazon is a bulletproof company because of many reasons, but suddenly you realize that, wait a minute, it might not be this like unstoppable juggernaut that everyone believes it is. And that kind of perception changes, and then suddenly the market's not willing to pay 150 PE. They're only willing to pay a 70 PE. Amazon's earnings don't need to change, but a PE ratio is a P divided by E. So the earnings don't have to change, but if you need to drop that PE ratio by half, you've got to drop the price by half. Amazon can crash 50% overnight without its earnings changing at all. Now that for me is absolutely amazing. And I think that when that happens, I think people that are following kind of like the fundamentals of investing might do very well in South Africa. Sorry, we've got someone's drawing some lines here. Okay, cool. So that's slightly longer term in the markets, but I mean, like I said, we've had a very harrowing time this year. Okay, so let me just go on. So yeah, it's been incredibly volatile. So what's actually happening in markets currently? So if you go back, I mean, obviously we had this. I'm gonna try. I don't know if I can draw, but you can see the big dip that we got in March thanks to the coronavirus, and then a very, very swift recovery.
Sorry,
yeah.
So you mentioned that there's value in the small caps, right?
Mm-hmm.
But okay, I remember reading an article, and I think about 80% of the JC market cap is from the top 40. Mm. And I think that's a sign that there's a lot of people are not even looking at the mid and small caps. But I think the question is, how do you go about finding value in the small caps? Because just as much as there's opportunities, I think it's easy to invest into a company that's not going to offer much value in the long run, because not all small caps are that great after all.
No, for sure. Yeah, 100%. Now that comes down to like investment strategy, which I can Okay, so when you come down to small caps, like investing in small caps it's almost, it's not a labor of love, but it's something that you need to be able to. So if you've got a background in finance, or you're an accounting student and you've got time on your side, then you can do deep research yourself. That's where the advantage in small caps is. So there's 2 problems with small caps that I have, and I'll go through those in a sec. But if you do the kind of fundamental research yourself, there's the technology that's available to you and the information that's available to you at the moment is far greater than it's ever been in the past. I mean, in the old days, like, you didn't have access to, kind of like corporate executives. You didn't have access to the information. You had to go and buy a share and get posted like a pack, to go through the company. You had to actually physically attend the AGM to listen to what was going on. That doesn't exist anymore. Like, these days, anyone can research. like anyone with the time and the inclination can research a company, probably, and obviously a level of understanding, but can research a company in the same detail as a bank sell-side analyst. The problem is that in the small cap market at the moment, you have to do that kind of deep dive research yourself, because in the large cap and the mega cap markets, and especially in overseas markets where I manage, we've got like JP Morgan. I've got the best research analyst on Apple. I've got he's spending he's spending all his time, and he gets paid hundreds of thousands of dollars as an analyst to research Apple and give me a fair valuation on Apple and give me his views on Apple. And then I've got 44 other analysts that I can go to at Goldman Sachs, at Merrill Lynch, all over the place, and I can get their research. And they are essentially keeping the management teams very, very honest, because in the world of research, those guys, those analysts, those what we call sell-side analysts that are researching those companies, they feed back to the management team all the time, and they say, "Oh, Apple, you're doing this, you should be doing this," and it's like this kind of think tank around the company. And part of that is because they essentially represent institutional shareholders, so they represent big pension funds and that kind of thing. Now, in markets where you have a lot of analysts, you have a lot of price discovery. So you have a higher degree of predictability on the company's valuation. So if a company is undervalued, and these analysts are like, generally the information will be priced in. In the small and mid caps that you're talking about, you don't have research coverage. So the reason you don't have research coverage is because pension funds don't really invest in small and mid cap stocks. Pension funds, it's just not big enough for them to move the needle. They take a meaningful position. If our big ones like Allen Gray, Coronation, let's say Investec Asset Management, if they go and invest a meaningful part of their balanced portfolio in something like, let me think of something like, that's quite, AVI is quite big, but my old company, Vunani, for example, they go and make a meaningful investment in Vunani as a listed company. Like, they're going to buy most of the company. It happened with Net1 UPS, with the whole, I don't know if you guys remember the whole Tfsa debacle. The problem with it was that the anchor investor owned 30% of the company, but it made up of the portfolio they managed. It made up less than like 1% of their portfolio. So they were just like, we'll plug less than 1% of the fund in there. If the thing works, it works. If it does, it doesn't. But there was no oversight from shareholders. So there was no one representing that company making sure that management was making good decisions. The shareholders didn't really care because it was almost too small in their lives. And that's the problem with the small and mid caps. They don't have the quality of research that other people have. So their prices are often mispriced. Now, you get, as you say, you get a lot of rubbish in there, but you get a lot of gems in there as well. But it takes a lot of that due diligence. You need to go out and do the research and actually work out, is this management team just talking rubbish? Is the REM structure, one of the best places to look is the remuneration structure for the directors. Are they basically, is management stripping all the fees out in CEO bonuses? And how much is feeding up to the actual shareholders? What is its dividend policy? Is it paying dividends regularly to shareholders? Is the company looking after its shareholders? And you'll find kind of the good companies and the bad companies. It's not difficult to filter them out, but it takes time to kind of do that research and kind of go and pick the right companies. And then my second problem with the small caps is, even when you've done that research and you've got a great company, you're getting your dividends, they're rewarding shareholders, often these companies, because there's not enough investor interest in them, and because they say they're not growing fast enough to justify the re-rating in their share prices, you're not able to exit with a profit, basically. So you buy the company, you sit with the company for ages, it trades on like a 5 PE, and it always trades on a 5 PE, and you don't get the excitement that'll just move that PE up to a 10 PE, where even that kind of gets that nice share price ramp for you, where you can actually make money as a portfolio manager or as an investor. So it's a difficult space to invest in. There's some opportunities in there, and there's some opportunities, I think, for smaller investors, because larger investors are excluded from that market, if you want to put it that way. Okay. So sorry, does that answer your question? It was quite a long one. I hope that answers your question. Okay. Cool. Okay, cool. So I'm just going to go back to, so I'm going to run through the rest quite quickly anyway. So what's happening in markets at the moment? So after that kind of like hair-raising crash that we saw in March, April, everyone was kind of asking us at that stage, oh, is this the bottom? Is there a double dip? Markets climb what's called a wall of worry. They call it the wall of worry. And everyone was like, oh, no, no, no. And no one really believed that markets were going to recover. And that's kind of like was almost a sure sign they were going to recover. But what really happened is we had the Fed getting involved, and we had central banks basically dropping interest rates and printing an incredible amount of money. So this is, like money print. It's like a meme that goes around on social media. But basically, Jay Powell, who's the head of the Federal Reserve, at the moment, they're not even thinking about raising interest rates. So here's a little interest rate chart for you. Sorry, ignore the line. I don't know how to get rid of that. But basically, this is interest rates. Okay, so I've done South African interest rates and US interest rates for you. So you can see the problem in the US at the moment is that they're facing what's called the zero bound problem. So essentially, interest rates after 2008 crashed to zero, and they don't want to take rates negative. So they started their QE programs, and they started something that is creating an enormous amount of asset price inflation. So a lot of money is filtering into equity markets because it can't find a home in the bond markets. At the moment, the Fed is basically like trying to drop the long end of the yield curve. So they basically, I mean, if you buy a 10-year treasury, so this is an alternative investment to a share, is to go and buy like a government bond. You'll get compensated in dollar terms. You're going to get compensated I think it was 5 points recently when I did the calculus, 5.7% for the entire 10-year period. It's going to be your return as a shareholder for lending the US government money. I mean, that's crazy. You can't invest in that. I mean, people have to invest in that. There's mandates that force people to invest in it. But as a private investor, we can't see value in the bond market at the moment. And certainly not when you've got equity markets doing what they do over time. So that's a 5-year period. You're looking at an 87% return versus a 5% return in a 10% period. It's too low. Are they going to? Okay, South Africa, we've seen the same thing. We've seen our interest rates collapse, and I mean, again, this is really symptomatic of the market post the 2008 crash. You can see we had a kind of a normal interest rate cycle up until 2008, and even in South Africa, I mean, we were doing interest rate increases, but they were quarter basis points, where we used to move it in 50 basis points, 1% increments. Our interest rates are now like we're facing what the rest of the world is facing, which is just a world in which consumer price inflation isn't really a problem, but asset price inflation is. And central banks that are very, very accommodative, which is helping to fuel massive equity market rallies, which is one of the reasons that like we've seen I think the increase in volatility. Okay, so this is a quick one. So this is what we track it. It's the federal funds futures. So it's basically people taking bets on whether the interest rates are going to increase or decrease in the US. Currently, this is all the way out to March 2021. There's 100% probability that interest rates will not go up in the US before March next year. 100% probability. We are going to have loose monetary policy kind of fueling equity markets for a long time to come. This little dip that we're seeing, so this is a chart from today, so the little dip we're seeing in equity markets, I really see it as a buying opportunity because there's no other place for people to find kind of real investment returns. The bond market is almost, it's almost not relevant at the moment. I mean, if you're looking at South Africa as a fixed income investor, fixed income being investing in something that yields an interest rate, you're getting like 4%. Like, yes, okay, inflation is low, fine, but I mean, you compare it to like what your inflation basket really is compared to like, say, like official CPI. You want to buy TVs, you want to buy anything imported, and you've got a weakening currency at the same time. I don't believe that a 4% interest rate compensates you for your risk of holding South African Rand personally. I think you have to hold a hard asset. You should be in equity. Okay, so this is just general. So this is unemployment in South Africa versus the US. This graph is basically just showing you is that like the US has done incredible things over coronavirus. So I know we were meant to link this all to coronavirus, but I mean, absolutely amazing. I mean, US interest, like unemployment spikes to like just under 16%. It was unheard of. Like how bad that was. I remember seeing that not the non-farm payroll, the US unemployment, the initial jobless claims number, and it was like the right-hand side of the chart just like evaporated. It looked like the y-axis. It looked like the chart was the y-axis, and I was like, this is absolutely mad what's happening in the US in terms of what the impact of what lockdowns have done to the US. But the difference between the US and South Africa is that the US has bounced back incredibly fast. And I saw it. So one of the companies that we invest in is Disney. So we're obviously looking at Disney quite closely because they have a lot of the big rate of revenue driver for Disney is the parks business. They're like, Disney World. There's a big driver for them. It's not just their kind of Disney Plus, which is their comeback to Netflix. And we kind of were very concerned because we were holding Disney into this, but it's amazing how the US system works. Disney literally just fired everyone. They were like, cool, protect the company, don't protect the workers, who cares? Fire everyone. That's what America does. But what happens is that keeps their companies alive, and their companies pay taxes. The taxes obviously go into the fiscus. The fiscus is managed responsibly, and all the people that were laid off essentially or put on furlough got income grants, like huge efficient income grants. It tided them over the coronavirus period. The business survived, and what happened is Disney just hired everyone back when the parks opened, and the business, the what do you call the golden goose, can continue now to lay eggs. And what you've seen is a rapid increase in share prices. Yes, a spike in unemployment, but unemployment came down again because those businesses were still alive to rehire people. South Africa, I mean, we've obviously got, there's a lot of, it's a very different situation. And I mean, it's not just government policy. Personally, I think that labor regulation in South Africa is just way too strict. I think, what I say, the three words that made America great are "you are fired." I think if we actually loosened labor regulation in South Africa, we would see unemployment come down so quickly. Young graduates would go into the workforce and pick up graduate training programs quickly. And even if it was only 6 months, it would be work experience. And for me, that I think would really turn around South Africa, just loosening our labor regulations and having a look at some of those, just a slight relaxation. It doesn't seem to be the way that we're going, and we are not getting the bounce back. Our unemployment, I mean, these are official unemployment numbers. Like, I think the unofficial numbers can be a lot worse. Okay, so that's kind of my take on unemployment and markets in general. But what now? Okay, so what are our clients doing? So we've got coronavirus, we've got markets all over the place. What are our clients doing? What are things happening? So I've talked a little bit about it, but essentially when you look at financial markets, like, all clients are different. So I just want to see what the next one is. Yeah, so if you're looking at investment, and I mean investment, like I said, like investment, there's a risk and return to any investment. So this is kind of like a standard chart that we show a lot of people like that are kind of new to investing as well. The higher the risk is on an investment, generally the higher your return is going to be. So money market and government bonds are low return, but they're low risk. So your volatility is going to be low on a bank account, but you're not going to get much of a return on it. It should actually be a bit negative, because if you convert it to real rates, you'll actually be negative. Corporate bonds, a little bit lower risk. Well, it's a little bit higher risk than a bank account, but you get a slightly higher return as well. And then you get the kind of blue chip equities, which are like the larger companies, which are, again, they're meant to be more stable. They're meant to be bigger. They don't have the growth opportunities of the small companies because they're already large. You look at something like Anheuser, like AB InBev, for example. So Anheuser, if you look at that, it's essentially got, it sells 1 in 3 beers in the world. Like, what is going to happen on that company that's really going to do something exciting for shareholders? Can it sell 2 out of 3 beers in the world? Can it sell every beer in the world? Can it, like, I don't know, can there be more people in the world that drink beer? Where's the actual growth in that company going to come from? It's difficult to see it. So then it just becomes a valuation game. It becomes, we're not going to increase our top line. We're not going to increase the revenue because we kind of saturated. If we sell 2 out of 3 beers in the world, there's going to be competition issues. Already when SAB and AB InBev merged, there was a huge like spin-offs of lots of different breweries because they couldn't hold all of them together. It's already kind of at capacity. So all they can really do is now to cut costs to try and return money to shareholders, and they'll grow at inflation. So they're stable. They're not going to go out of business. They sell 1 out of 3 beers in the world, but they probably don't have the growth potential of a smaller company. Small cap equities, higher risk. It's not as stable as AB InBev, but it's got, if you're only operating in the Western Cape, for example, to double your business is not difficult. You just go and operate in Joburg as well. To double your business again, service the whole country. To double your business again, start selling internationally, and shareholders will reap that kind of growth and that kind of return if that growth is organic. So what will happen is you'll buy a share at 10 Rand and it'll go to 20, and then it'll go to 40, and then it'll go to 80. and you'll make multiple returns on it. You're not going to get that kind of growth in big blue chip companies, but you're not going to get the stability either. As we were chatting about earlier, smaller companies are more risky. So smaller companies, they can fall apart. They can go bankrupt as well. Whereas when you sell 1 in 3 beers in the world, chances are you're not going to go bankrupt. You're just going to go through a restructuring, maybe sell off a few territories. So more stable. And then obviously, okay, so then I said higher emerging markets, but the highest risk stuff is actually derivative based. You gear up, use leverage, that kind of stuff. There's all sorts of ways to get your risk extremely high. And that's a lot of guys will do that kind of on online trading. So what have our clients been doing? We've had guys that have panicked. Very few of our clients panicked though. Like, I mean, we had a couple of clients that like in the dip, they phoned us and they were just like, I actually caught one client just emptying his portfolio. It was a big portfolio and he was just kind of selling share by share by share by share. I was like, I phoned him. I was like, what are you doing? And he's like, this market is never going to stop falling. And I was like, no, just please stop. And then he stopped at about M. He had over 100 securities in the portfolio. He stopped at M. He waited like 4 or 5 days, and then he bought everything back again. And he was like, yeah, I was panicking. Because when you've got a lot of money in the market and the markets crash, you can, like, you might sit back and go, oh, when it crashes, I'm not going to fall for that. But when you go through a crash like that, it's very difficult to be that strong hand. So on the other hand, I mean, obviously, so this is essentially our managed portfolio that I run. So this is my portfolio. We've actually done great this year, like really, really solid. So we were looking at it in terms of a valuation play. So we were looking at it just saying that, okay, so this is primarily invested in offshore markets. But we were looking at it in terms of just saying that like some of these companies are very, very overbought. So we have, I mean, we own Microsoft, we own NVIDIA, we own Amazon, we don't own Facebook, we don't own Apple. We own, what else do we own? That's kind of like very tech driven. We own Visa as well. We've got a big position in Visa at the moment. Now, what we did is we actually halved all those positions. So we were looking at it, and Amazon had just been going absolutely berserk. So we halved our Amazon, we halved a lot of the positions just to come, one, it was part of a reweighting cycle, but we actually went from overweight tech, just on a valuation play, just to say, listen, this thing is running, this is looking like 1999 tech bubble. Let's cut down on our tech exposure. So we did that. We halved our tech exposure, which has been great the last 3 days because we've been like, yeah, we were right. But we went equal weight tech, and that left us with a lot of cash from the portfolio. And then we were kind of like very hesitant to redeploy. So we started buying. So then we had cash in the sell-off as well. So we had about 20% of our portfolio in cash, and we actually had more than 20% in cash in the sell-off. We managed to buy in fairly low down as well. And we've done great on the portfolio for clients. So the right-hand chart is basically our worm, is the red worm, which is basically the last, call it 5 years of our portfolio performance. I think we're up 80, on the next slide. So we're up 86.83% as of the end of last month. That's in dollar terms. So if you think about it, this is 5 years, we've made 86.3% versus if you had invested in a US Treasury, you would still be halfway to getting your 5.6% return, which is just crazy. Again, you've got to be in equity markets versus the bond market currently. And yeah, then what I've done here on the left-hand side is a relative outperformance. So often what you see if you listen to fund managers or you go and listen to portfolio managers talk, they'll go put up a 20-year chart and they outperformed right in the beginning. And then they kind of got this outperformance and then they just go and track the market. They benchmark, this is benchmarked against the MSCI World. So it's a global portfolio of equities. And then they just go and basically mirror the MSCI World for the next 20 years. And they go, we got our performance in the beginning. And anyone that's new to investing probably underperforms with the fund manager. But they can go and give these wonderful charts how they beat the market. This chart is just up so to show you, like, we have been beating the market. Okay, so we went through, when we actually started, was a more difficult time for us. 2017 particularly, we just tracked the market. We weren't generating any real alpha. But when things got hairy now, that's where we've really managed to outperform on our stock selection. So I don't want to run over time, but yeah, so that's that one. So this is basically, okay, so just performance metrics. We're up 86% versus our benchmark, up 49. Over 3 years, we've done 50% versus, that's the last 3 years, versus the market that's done 25%. So we're basically tracking at about double what the market is doing, which I'm really happy with, obviously. You can see this is a monthly performance chart. So you can just see the last couple of months this year, volatility is off the chart. We've had big swings both ways, up and down. Okay, and now, yeah, so that's, like, I mean, any questions we can maybe hold till the end now, because I just
questions here.
Sure. Okay, shoot.
Is Sun International, Tfsa, and City Lodge are some of the hotel services losing value in the market. What do you think could boost this sector?
Oh, it needs to reopen. Yeah. So that's the main thing. I mean, we've got clients that like are hoteliers, and I mean, you know, if you look at what's happening, like, I mean, City Lodge is primarily like driven by business travel as well. Now these companies like City Lodge, for example, is I mean, it's been it's kind of like almost like I'd compare it almost to like a Comair. It's been around for so long. It's well managed. It's kind of a very steady Eddie kind of company. It just goes along and does what it has to do. The problem is that, like, obviously with business travel shut down, it's absolutely unprecedented. It's obviously going to have a major impact on the company. But for me as well, like, you look at a company like City Lodge as an investment proposition. I mean, it comes down to valuation play, sure. And it has always commanded a premium just because of the way that it's been managed. But the problem for me is that I think business travel is changing as well. You've got to be cognizant of how the world is changing. I look at these meetings. In the old days, I would have driven to Wits and we would have given this presentation in person. I look at like how we are doing client meetings these days. I mean, literally, we stack 8 client meetings, you know, in the morning, and we have half-an-hour client meetings with a whole lot of people because we don't need to drive anywhere. Everyone is accustomed to using Zoom or Microsoft Teams or whatever it is. I think the amount of business that is going to be done in future, because remember, a market, it's not just about looking at City Lodge and looking what its revenue figures and what its earnings figures are in the past. That's part of it. That's part of what feeds into the valuation. But as equally important is what is going to happen in the future. That is what a market is pricing in. Now, you've got to think, what is the future for City Lodge in South Africa and in its businesses in South Africa? Great hotel chain, Road Lodge, City Lodge, you know, I think it's Town Lodge as well. So it's great, but what does business travel look like in the next 5 years? What is their revenue line going to look like in the next 5 years? If instead of flying down to Durban and going and staying in a City Lodge hotel because I've got to go and see 4 clients, I can jump on Zoom and go and see 4 clients. You know, that is going to impact its study. What about apps like Airbnb, where you literally can go and, you know, go on an app and go and rent a place for 3 weeks and you don't need to go and stay in a hotel anymore? Is their value offering still the same? And I think that's one of the big themes in markets at the moment. It's one of the reasons that we've had this big, you know, massive fueling of the bubble in tech, is because a lot of the tech companies are really changing the way that the globe operates. Okay, Microsoft, just in terms of its suite, is great. It's one of the reasons we offer it, because you can, you know, I think a lot of people are going to be moving towards it. But I mean, you look at the things that are happening at the likes of Google, like underneath, like with like their Waymo project, or their Moonshot projects. I mean, there's incredible technology that's coming through, that you as an investor want to, in my mind anyway, is I want to harness that type of growth and that type of those type of products that will literally put businesses like under almost overnight. City Lodge, okay, obviously is going to be more robust, but I mean, you look at Tfsa, you look at, like, you know, companies like hotel reliant, but also gaming reliant. You know, we've already seen, okay, so one of the reasons that like stock markets have just been so berserk, if you guys follow Robinhood, is basically you shut down sport and you shut down betting and people just move into the markets and it becomes a casino. But the point is that there are these like huge online casinos. The idea of going to a casino to put coins in a slot machine anymore, like that's changing. The casino model is changing as well. As I believe that idea of gambling is it's almost a human need. It's something that is you know, it's okay. You still call it a sin stock, but it's like, you know, you look at that. in terms of smoking or something like that. Like that kind of thing will be serviced in the online world as effectively as it used to be serviced in a brick and mortar world. So again, for me, you know, you're looking at, I'm not saying hoteliers are a legacy company, but for me, I think there's more exciting things that you can look at personally. I don't know if that answers the question, but okay, I'm just going to quickly skip because I don't want to run out. So this is something I did for like a whole group of accountants a while ago. So I worked out kind of how, like it was, okay, this was a couple of years ago, but I kind of realized that I've got more than 50,000 hours in the financial markets, which they say 10,000 hours to be an expert. So like, I just thought I'd share some lessons that I've learned over the last 50,000 hours of watching stock markets and dealing with clients and dealing with people's money. The first lesson that I've learned is like, don't be arrogant ever. And this like maybe comes down to what you were saying at the beginning of the thing that you guys have come up, you know, guys have made 200% returns in 2 months and guys have lost 100% in 2 months. One, don't be discouraged, but also never be arrogant. When you're getting it right in the market is the time that you've got to be so careful, be more cautious than you've ever been in the past. So it's a great quote. I love this quote because it really sums up markets for me. What gets you into trouble is not what you don't know, it's what you know for sure, but just ain't so. And it's something that like we often get clients like, I mean, you get clients like, I mean, obviously you guys understand what insider, I hope you do, if you're in kind of the financial services kind of side of the university, but insider trading is essentially trading on knowledge that's not publicly available. And it's obviously illegal and there's huge penalties for doing it. And you always get clients like, oh, I've got this inside tip. And let me tell you, it's like those are the guys that lose the most money. It's when they know something for sure, but it just isn't true. Like I think when you're constructing a portfolio, when you're approaching your investments, always err on the side of caution. Always believe that you don't know what is right. Even when you've done an incredible amount of research into a position. I mean, I've traded literally millions and millions and millions, actually billions, almost trillions probably of rands worth of stock, not, you know, for clients. And I've made this investment decision of when to push the button so many times. And even when you have the best research and you've got everything and you're so sure that this is it, you've got to come with a healthy dose of skepticism, and you've got to understand that anything can happen. You're trying to predict the future, and even the best models and the best research can all turn around in an instant. I mean, we were lucky, like with coronavirus, one, because we picked it up early. Like we were kind of watching China at that stage anyway. We saw what was happening in Wuhan. And I mean, one of my colleagues, Krista, actually wrote an article it was on the 20th of February saying, I mean, I remember walking out of the office and just thinking, like, saying, should we just sell everything that we own because this is going to be a problem? He wrote a whole long article about the dangers of coronavirus and why the markets are so high. It's one of the reasons we went in with such high cash weighting. But things like unprecedented things happen all the time, you know, and it's like I have to assume that there was a huge degree of luck that we happened to pick up on the coronavirus. It's one of the reasons that we've done so well in terms of performance this year, because so much of this is just so uncertain in our game. Investing it takes a huge amount of patience, but it's also, you have to make decisions with very limited information. It's why it's so stressful as well. Like it's really, it can be very, very tough, because especially when you know, like especially a lot of like the A-type personalities work for us. And those A-type guys, they want to know that, like, I've done the work right, I've done everything, I've ticked all the boxes, now I want my result. And you can get everything right, and you can still get a bad result. So I think being humble is always very, very important. Okay, in terms of which, okay, so the next two kind of like complement each other. Anyone can save, and anyone can become rich. It's really like what I've also realized over time is that, you know, being wealthy, and I mean, we deal with like uber wealthy clients, billionaires, and we deal with very, very like entry level investors, guys that are literally coming and opening their first tax-free savings account. You know, I can honestly say that there's no, like, being rich is not about money. It seems like a cheesy thing for me to say, but I've got some very, very wealthy clients that are incredibly miserable, that have very, very poor qualities of life. And it's got nothing to do with money. It's got to do more with their attitude than anything else. And I've got some and it's almost money independent, if you want to put it that way. But yeah, anyone can save and anyone can improve their position by making smart investments and by putting aside money early. Second, the third thing is you're only really competing with yourself. And this is something that, like, I was doing these lessons for kind of like a wealth building thing with some, like, it's basically accounting graduates. The amount of clients that have damaged themselves by over leveraging and going too aggressive because they were trying to keep up with other people in their social circles is incredible. You would not believe that. Like, that and divorce are probably the two most. Okay, divorce is a huge problem. If you want the best financial lesson I can ever have, when you get married, never ever get divorced, because that will wreck you one day. But it's very important to stay married. But if you're looking at social circle, there's this wonderful quote, like another portfolio manager at a different firm said once. It's like, live like no one else now, so you can live like no one else later. And it's like you see these guys that are always trying to keep up with the Joneses, and they kind of like, oh, we're not making enough money, push my returns harder, I want to get more aggressive, and it's weird questions that we get. It's like, Gary, is everyone else also struggling in this economy? Is my business, is it just me, or is everyone struggling, right? And they're kind of asking for this affirmation that it's not just them. And it's like, buddy, it's totally up to you. Like, you are managing your life. It's don't, and as soon as you try and you try and overcompete, have the fancier car than the guy next to you, have the bigger house that you can't really afford, that's where it goes wrong. Literally, live humbly, live simply, save as much as you can. And those are the clients that are the best. They're the people that end up with the best portfolios in the long run. They end up with that financial security, and they achieve financial freedom the quickest. So that, I would say, is, don't compete with other people. If you drive a bad car, like, so what? Like, it's really, it's no big deal. Like, it's not something that I believe that people should hold as important. And it certainly will help you in your financial journey. Not worrying so much what other people think. Seek knowledge and understanding. Like I said, like the kind of deep dive due diligence that people do. That is absolutely crucial. You've got to understand what you're investing in. And yes, you can do everything right. You can tick all the boxes and you can still get slammed. But doing that due diligence is a far better way of ensuring long-term success in your investing than always counting on the luck just swinging in your way. I know the whole thing, I'd rather be lucky than good, but trust me, it's better to do the knowledge, take time to get the understanding. And the next thing is start yesterday. Like, you guys are so young, and it's something that, like, I see people normally, people often come to us when they kind of like 35, 40. That's kind of when they've been working in their career for a while. They're kind of starting to get bigger salaries, and they come to us then and they say, okay, now I need to start investing. What have you done so far? Oh, nothing. And you're like, what have you been doing with all your money up until now? Oh, nothing. Like, I've got a wonderful client. So he's not particularly wealthy, doesn't have a big salary, but he's got a savings culture like I've never seen anyone have. He puts away probably like 70 to 80% of his salary. He lives very humbly. He does like side hustles as well. He does like little marketing projects for companies. He doesn't make a particularly large amount of money. His income is actually very low, but he's done it from when he was like 15 years old. His portfolio is bigger than people. I've had people that have worked for SOEs and multinational companies that literally have 5 million rand a year salaries and haven't got 5 million rand a year in savings. And you kind of look at that and you go like, what on earth went wrong with your financial journey that no one stopped you and said, put something away, And I look at his, and I mean, he is so sorted. He's such a chilled out guy. He's so happy because he's now got kids and he's married, he's got kids. He kind of owns his house. He's got this like really, compared to what he earns, huge share portfolio, and he doesn't need to take we chat about all sorts of things. So he's like, he doesn't insure anything anymore because he's got enough money in the bank now that if his car breaks down, he just can buy another car, So he saves on his insurance premiums, and it just compounds and compounds and compounds. And it really is amazing. And the sooner you start, so they say the best time to plant a tree is 20 years ago. The second best time is today. So you guys are lucky in that you're young. I would say get invested sooner rather than later, and really take a long-term view on this stuff. Finally, what can you do now to change your life? I would say use the tax-free savings account vehicle. I can take you through the calcs. I think we're out of time anyway. I'm over by 3 minutes. I can take you through the calcs, but the point is contributing that 36,000. There's no restriction on geography. You can go and buy Signia trackers. You can buy whatever. You can't buy shares inside it, but you can buy ETFs. ETFs are like exchange traded funds, so they kind of are baskets of shares that allow you to track global and local indices. Get as close to that 36,000 Rand saving a year as you can. And even if you can only do this year 5 grand, do it. Put it aside. You will be absolutely astounded at how much that grows. The tax benefit, and I mean, I can go through it, but you know, if some, like there's this crazy numbers that the guys worked out on the desk, that if you put in 36,000 Rand into a tax-free savings account for a kid at birth, so we use it as a planning vehicle as well. So if you've got kids, you kind of put literally one lump sum of 36,000 and you never contribute again. You don't even make the 500,000 Rand limit. By the time that child is 65, they will have, I think it's the equivalent of a 20,000 Rand a month salary in today's terms for the rest of their life. And all of that because a parent made one decision to put 36 grand away when the child was born, and then let compounding take its place. It's a weird thing about humans. We can think in a linear way, but we can't think in an exponential way. It's very difficult for us to picture exponential moves. And having the ability to let this thing compound over time, the quality of life that you're going to have when you're older, it will change everything. So I would highly recommend that. Finally, the last thing is we do a lot of research notes. So it kind of goes back to my lesson 4. Sign up at randswiss.com. A lot of this stuff is free. If you pop an email to us, like, so we normally our morning note, which is a daily newsletter on like where the markets are going, what the markets are doing, and the monthly review, which is what I write just about our fund and what we do and kind of our thinking on where the markets are going. Those are complimentary. You don't have to have an account with us to get them. Anyone can sign up. You literally just pop an email on the website. You can sign up. You'll get that content free of charge. One goes monthly. If you don't want stuff coming every day, that's the monthly review. The other ones go every day. And then obviously clients, we give a lot more research. So if you do open an account with us or you do anything with us, we do like tech trader updates. So this is like active updates on the market all the time, saying like today the guys were buying Nedbank, which was wonderful because they sent out the SMS yesterday afternoon and it's up like 8% today. So they're doing well. But yeah, that's kind of like to try and guide clients just around their kind of shorter term moves. And then we've obviously got like hardcore partners that send out like more deeper fundamental research. But again, those notes do require an account. But I'm sure for you guys, if you kind of pop us a mail, if you just pop a mail to info and said you watched the webinar with Gary, I'm sure they'll comp it to you anyway. So like, I mean, technically it's not for clients, but I'm sure they'll add you to the list if you just request it. And that is my presentation. Thank you for listening. Okay, I see there are some questions, so I will go through if there are. Okay, cool. So I don't know. Yeah, I don't know if we got a time limit here or not, but if you guys, yeah, so that's the end of the formal presentation. Okay, Sun International, Togo Sun City Lodge, hotel losing value in the market. What do you think? Okay, so we answered that one. The markets have been brutal to the construction sector, with ESAW and Group 5 being the latest companies to delist for the JSE. Avenge is struggling. What are the main factors responsible for the devaluation of the sector? I noticed most of the construction companies are also getting devalued. Is there hope for the sector? Wow, it's a good question. Hey? So construction is a very, very cyclical sector. And unfortunately, like what's actually interesting is construction can do very well in times when markets are crashing and when markets are doing really badly, because so much of it requires like often the mega projects that they do are contingent on infrastructure spending. And if the government is opening loosening the purse strings and spending more on construction projects, then they have an uptick on the back of that. So it can be counter-cyclical to the business cycle, which is quite interesting. Well, I've always found quite interesting. The problem with the local market, though, so there are, you look at, so there are companies that have done okay in the construction sector. But yeah, the big construction groups like Murray and Roberts, Group 5, Hedge, it's been absolute decimation. It's part of it is that the government spending just hasn't come through for them. The second is the economies in the doldrums, and the building projects just aren't there. The second, another factor is that margins in construction are razor thin. You go and do 100 million rand project, you're going to make R1 million in profit. It's a very, very cutthroat, very difficult industry. The physical structure of the industry is also quite interesting. So you obviously get the big building groups like Murray and Roberts, Hedge, etc., and then they kind of subcontract down to all the subcontractors. Now, often a lot of the economic value is stripped out at subcontractor level, and the big groups don't actually make those kind of supernormal profits for investors. So personally, my dad was in construction, so put it that way. This is coming from an insider, but I personally don't like investing in the construction sector. We've had clients on a intermediary basis, which is where they buy their shares and we just kind of are facilitating the transaction that buy into construction sector. I've never, on a discretionary basis, as in using my Cat 2 license and buying on behalf of clients, I've never bought a construction company for a client. Never. It's a very, and I'm sure someone's going to watch this and be like, Gary, you once bought this, but really, to my memory, I cannot think of a time that I've bought a construction company, just because I don't like the way the sector operates. But yeah, that said, it is very, very cyclical. So if you get into the right swing at the right time, amazing stuff can happen in the construction sector. Yeah, but it's for me, it's just, I also look at the oversight on the construction sector in South Africa. It's just not there. You look at the kind of regulations that they've got to face compared to some of the international counterparts. It's a difficult. It's an industry you don't want to be in. I'd rather be in retailers and banks. Thank you very much. I'm very happy in asset management. Like I said, my dad was in construction. The one thing he said to me, he said, Gary, whatever you do, don't go into construction when you grow up. Don't ever go into construction. So I think I took that to heart with my investment philosophy as well. So very, very difficult. Okay, considering the current market position, what kind of investment strategy is most ideal, including making alternative investments in commodity hedge funds, etc.? Okay, also very good question. It's great questions, guys, really nice questions. So when you look at alternative investments, so Yaku, who sits on our desk as well, so he's a Kaya, so he's a certified alternative investment analyst. And I've worked a lot with kind of alternative investments over time, because my first kind of smack as I walked into the market was yeah, Gary, run this hedge fund. And I was like, what? I know almost nothing. And it was a very rude awakening to what alternative investments can be about. But yeah, how can I put it? So you've got to look at it. Okay, so from our point of view is, if I go back to okay, so I don't know, I suppose I can draw. Okay, I'm actually going to kill the presentation now and just go back to normal stuff so that you can see, hopefully. Yeah, so when you look at investments, you've got basically, I'm going to hold that up, you've got an efficiency frontier that looks like that, right? I know I should be using Zoom, but I'm old, I'm not a millennial. So you've got A and B and C. So you've got these three points, right? I don't know if that's going to be backwards for you. That's an efficiency frontier. As long as you're buying a product that's basically sitting at C, which is on that frontier, I'm totally happy. You can buy a hedge fund, you can buy commodities, as long as the way that you're investing in the commodities or the hedge fund makes sense and is efficient. I would be happy to buy for a client, because I don't know the future. I don't know if buying oil today is great or bad. I don't know what, we can go and look at the oil market, we can take a view, but as long as the kind of oil contract that I'm selling you is a good contract and is an efficient way of accessing the oil market, I think that's fine. Same with hedge funds. There are plenty of hedge funds that are really, really good hedge funds that have good methodologies. When do you use a hedge fund, and when do you use a a normal fund? A hedge fund is deliberately used when you want to get uncorrelated results for a client. So if you've got a big portfolio that's linked to the normal equity market and you want to get something that is uncorrelated to the equity market, then you buy a hedge fund. Now, for me, if you're looking for an uncorrelated return, a hedge fund is a great place to invest. There are plenty of hedge funds that sit at B, as in at B is inefficient. Their risk versus the axes here are risk and return. So they're just a suboptimal. They're not doing it correctly. They're taking on just the wrong amount of risk and reward. At A is obviously impossible. Sorry, it's not risk and return. It's sorry, have I drawn that wrong now? So I'm getting tired. It's been a long day. It's not risk and return. It's okay, idiot, don't worry about that. But basically what it is like B is like as a suboptimal product. It's not going to, you're going to basically take it's inverse risk return. So it's basically, you're going to take a suboptimal, you're going to take on like a suboptimal level risk. You're going to take on more risk for a low return. The same as like the A mark on that little graph is impossible. It's like you're taking very low risk and very high for a very high reward. It doesn't exist. A in this model doesn't exist. So sorry, I'll draw it out for you here. So that's okay. Well, don't worry about it. You can screenshot me after. You can WhatsApp me afterwards. So I'll try and share it with you, the chart. But basically, my point is, taking high risk for low return is not something that you want to do. And it is very, very possible. Taking low risk for high return is something that isn't generally possible. It's like, if it's too good to be true, it usually is. That's kind of the idea. But there's nothing wrong with alternative assets if you're using them in the correct way. Like recently, we were really, really excited about kind of looking at the gold market, and people hated me for it. They're like, Gary, buying gold, you're not even a real portfolio manager. And I was like, guys, I want to play the zero bound problem. Like, this is the way that I play the zero bound problem. Like, this is a legitimate investment case. This is not some crackpot that's buying whiskey and gunpowder and hiding stuff under his stairs. This is a legitimate investment position in an alternative asset. I got a lot of flack from people about it. I was like, and I was like, guys, like I could justify it, and I was happy with it, and it did really well. So, okay, in your opinion, okay, so that's kind of on alternatives and commodities. I mean, we did a wonderful presentation years ago at the Rand Club where we actually got a wine expert in, and there's a wine ETF that you can track as an alternative, where you can actually literally invest in wine digitally, which I think is also an awesome bonds cash property. And then your alternatives comprise of commodities, hedge funds, baseball cards, wine, all of the kind of derivative stuff as well. Speculate on whether on our platform you can also buy, my favorite so far is like you can buy orange juice futures in Miami. So that's also quite fun, but yeah, something a little bit different. Cool. Okay. What is your opinion on JSE still offer viable returns for investors compared to other stock exchange? What is your opinion on African Rainbow Capital as good growth? I like ARC. I think they're doing very, very interesting things. Local versus offshore is a difficult question as well. I'm going to expand to local versus offshore. Like I said, I mean, a lot of our clients are moving offshore, so I didn't really go through like what our client flow is at the moment, but it's quite clear for me that like the interest in the JSE has dried up a lot locally. Now, I don't know if that means that there's a huge I don't know if it's, you know what I'm saying, there's a big contrarian play on it where you just say buy JSE now and sit tight, because like I say, if that sentiment changes overseas where emerging markets become flavor of the month, what's happening on the ground in South Africa no longer matters. I mean, there was a stage where our retailers just were like, they were telling a good story about expanding into Africa to the international community. And I mean, our retailers some of our retailers were like 70-80% foreign held. Because they just had a good story and foreigners wanted to get access to it, and they were kind of, they looked at it, they kind of understood the risk premium, and they went in. So I think the JSE offers compelling value. The returns haven't been as bad as people expect, because we've got that international component to it as well. And I like there's many JSE stocks I like, but I think if you really want to capture bleeding edge, like kind of tech stocks, we have Naspers. That's about it. We have a couple of like data techs and stuff like that, but nothing really. I mean, you want to go and invest in AI or try and capture something like, I mean, Elon Musk is putting chips in the heads of pigs at the moment. I mean, there's some really crazy stuff happening in the world. We've got CRISPR coming out where people are going to alter their own genetics. Like, we haven't had access locally to those kind of investment themes, which makes international investing for me very, very attractive. It's one of the reasons I run a global portfolio rather than a local portfolio. We still have local options for clients, especially within the Reg 28 space. At the moment, because of the pension fund, Reg 28 is essentially that, like the retirement rules around pension investing, that keeps a lot of the money locally. But I mean, in terms of discretionary private money, a lot of the stuff is shipping overseas. I mean, and I don't know if it's because we're running a treasury business as well. I mean, you know, I've got clients, so we've got guys that basically they invest on behalf, so they do like big foreign direct investments into South Africa. So they'll come and build a factory here, and he introduces like Spanish private groups to come to South Africa. There is money flowing this way as well. So it's not a one-way traffic out, but from a private client point of view in South Africa, the guys using the 1 in 10 million rand allowances it's a regular feature. I can tell you right now, 1640 to 1730 is the range on currency. If we dip below 1670 to call it 1630, our treasury desk is stacking with orders to buy dollars and invest internationally. At 1730, we see businesses bringing money back, repatriating earnings because they have to. So that's kind of what the rand flow like in physical currency transfers is like. But yeah, international stock markets, like there's some really exciting stuff out there. So and it's mainly it's more from a diversification point of view, I think. How much can you start investing with rand Swiss? So our base account, so it's actually it's a good question. So our online trading accounts, you need a minimum of 5,000 rand to open an account. The tax-free savings accounts you can start with as little as 300 rand a month. So the TFSAs are really, really low cost. Generally, we run the TFSAs. The idea behind the TFSAs, it is a loss leader. We make zero on the TFSA. We actually launched it as a free product as well. So other than, so there's a mandatory 25 bips brokerage we've got to pay on your initial implementation. But if you have a secondary product with Rand Swiss, so basically saying like, we want it as an introduction to clients, so come set up your TFSA with us, but then come and do something else. Do an offshore transfer, open a bank account, do something else with us as well. That's generally how we see them, and then we kind of cut the cost to zero on those for you anyway. But standard cost on the TFSA, if you're just opening a TFSA, I think it's like 27 bucks a month, but it'll be naught if you've got a secondary product. So you open a 5 grand trading account in the TFSA with us, you're basically paying naught on your TFSA. And there, like I said, I think it's 300 bucks a month minimum at the moment that you can invest on a regular basis. Lump sum is, I think, 1,000 rand in the TFSA. But yeah, trading accounts start at 5 grand if it's appropriate as well. But remember, if you do sign up, we're going to chat to you, all our clients we talk to before we open an account for them, just to make sure that they're going the right way. You know, this is a long-term business. We might have only been around for 5 years, but we plan to be around for the next 50 at least. And so every client that we kind of open, and every client that we work with, even if you are a student and aren't working currently, it's about plotting your journey. This, like I said, the best thing to do is go and sign up and get to know us. because we want to work with you, but we want to do it in the right way, and we want to plot your course correctly. If one may, online trading deposit. Okay, so I've answered that question. So it's $5,000 for an online trading deposit. But yeah, we are gonna kind of pre-qualify you as well, just like kind of talk you through it and find out the type of investing you want to do. Because if you just want to go and like build up an ETF-based portfolio, for example, there's ways that we can do it without doing it in an online trading account that might be a lot more efficient for you. But like I said, it doesn't matter how big or small you are. We always kind of like go and speak to you first and understand who you are. Even though we run online trading, it's not about go and sign up on a website and then just run through a process and get stuff and it's all automated. I mean, we really believe in kind of a relationship-driven approach with our clients. Earlier you mentioned that some of the labor law, it could help reduce unemployment. So what did you mean? Could you unpack this a bit more? Yeah, sure. If you want, it's quite a contentious topic, because people get quite upset with me for saying this, but basically, for me, like, you know, I mean, I remember like a big argument. We had it on CNBC. I actually had it with one of, I can't remember who it was. It was one of the unions. And it was about the minimum wage and just saying that like we should basically increase minimum wage because this is essentially what we need to do. The problem for me is that the real minimum wage in life is zero because the job disappears. So if a job isn't viable at that rate, the job evaporates and then the minimum wage is naught because that job doesn't exist. And what I've seen from running businesses and from seeing how businesses work, there's so much to be gained from experience. I mean, we get guys literally coming to apply to us to say, like, I will come and work for you for free. And I mean, we know no one works for free and all of that, but the sentiment is just give me some experience. Because if I just get some experience on my CV, that is going to open up the world to me. And I mean, we can see it. Like, it would be so, like, I mean, I wish I was in a position where we could hire 50 people on the desk tomorrow, and then just fire 40 of them after 3 months. Now, because then I would get the best 10. My business would become more efficient. Our company would become more efficient. But not only that, the people, yes, it's sad that they got fired after 3 months, but they got 3 months experience working in a stockbroker, understanding how the mechanics of markets work. And even though they worked only for 3 months, it was better than not working at all. But I can't do that because now I know that if we hire someone, we basically have got them for life because the law is so stringent. Because as soon as, if we don't have, like, you can't just fire people, you can't follow that model of come and hire and fire. You know, it doesn't work like that. And I think a freer labor, like, I believe in a freer labor market. It's just what I believe in. I think that makes businesses stronger, and with stronger businesses, it will encourage hiring. One of the biggest things that are preventing hiring, people are terrified to hire graduates. You're terrified to hire a graduate because if the graduate doesn't meet your expectations, there's nothing you can really do about it. You've got to go through, sorry, I've got to drink some water. There's such an onerous labor, like compliance with labor law that you have to go through that, you know, small businesses can't afford it. Like, they just can't afford it. Like, it's difficult for them to hire, and small business is the absolute driver of employment in the economy. It's not the corporates that are creating jobs. It's small and medium enterprises. And I mean, if you freed it up, they will hire. Like, I really believe they will hire if they can easily cut people. And yes, it's unfortunate, like, to have to fire someone, but is it more unfortunate to hire someone for 6 months and then fire them or never hire them at all? And I think that's what strict labor regulation is doing at the moment. It's just creating a situation where people aren't hired rather than let them be hired and be fired. Okay, if I can put it that way. I don't know if that answers. I can go into more detail on it. I actually did HR as a major, so we had to do collective bargaining and stuff. But yeah, unions are strong in South Africa, and like, in my mind, you almost need to go the Thatcher route that the UK went, and it's one of the reasons that the economy recovered. You need to be tough. It's just one of those. It's one of those really weird. It's like Dambisa. I think it's Dambisa Moyo wrote a book called Dead Aid, which is about aid to Africa. Amazing book. I think she works for the World Bank now. brilliant concept, saying that like aid is keeping Africa poor. And it's by these big aid payments to African countries that are kind of actually, it's almost creating a fake Dutch disease where it's stifling the emergence of a manufacturing and agricultural sector, because there's essentially these aid payments coming down, and it's deliberately keeping like African countries poor. And she said you actually remove the aid, and you'll see an emergence of those sectors in the economy. But so often economics works that way, where you think it's almost like, and I've noticed it in money as well, and finance, just anecdotally with clients, the tighter you hold on, the more that slips through your fingers. You almost have to open your hand and to receive. It's a weird concept, but yeah, so for that, it's the same idea on labor regulation. It's kind of like, yes, you want to have strict labor regulation because that protects jobs. But if you actually are unafraid and open your hand and strip away the labor regulation and let the free market operate, yes, it'll be more difficult for those that have jobs, but for the people that don't have jobs, there will be more jobs available. Like it's one of those kind of, often in economics, there's that almost counterintuitive approach that you try and do one thing, but that one thing in the system tweaks something else, because an economic system is so complex. It is such a complex animal that you tweak one thing here with a change in policy, and it has this huge ripple effect, and often unintended consequences happen. And I think, and often you do something that seems very unintuitive, and you get a very different result from what you thought you were going to get, if you put it that way. Same as like Fed policy in 2008. Everyone was like, they're printing money. This is absolutely insane. You're printing money, inflation must go up. Inflation for the last 10 years has been nowhere. Asset price inflation went up, but it was a totally unexpected consequence. Everyone at that stage thought we've got to have hyperinflation, US dollars going to zero, total hyperinflation. You're not going to be able to buy a Coca-Cola, because a Coca-Cola that used to cost $1 is now going to cost $100 because of this crazy QE program. Totally didn't happen like that. So there's often financial markets are a lot more complex than people realize, and trying to, and you kind of almost have to test and tweak is my feeling. This might be do you think it's ideal to start a business and or invest in the entertainment world, focusing on classical music and dramatic arts? That's a very interesting question as well. So for me, I mean, like, this has been my journey. I started financial services companies, so it's a little bit different from classical music. Like, I love entrepreneurs. I think people that are starting businesses are the future. And I think, if you're an entrepreneur, it's in your blood, it's in your soul. It's something that you're always going to want to do. Not everyone is an entrepreneur, but if you've got that drive to start a business, let me just tell you this, it's hard. It's really, really tough. You need to get capital. You be ready for work like you have never experienced in your life. I mean, I run 16 to 18 hour days often. And it's tough. Starting a business is always tough. Focusing on classical music and dramatic arts, there's nothing, it depends on the business model. It depends on what you're doing. Every industry has excellent people in it. And I would say that if you've got an angle and you see the opportunity there, why not? I see nothing wrong with it. I mean, there's this wonderful story about a guy who was very disappointed in his child that because his child wanted to build sand castles for a living. And this guy was like, I want a doctor or a lawyer. Like, what is this kid doing? This is crazy. And he became the best sandcastle builder in the world. And the next thing, they were flying him to Japan to go and build in these competitions. And he was doing these sand artworks in mall. And the guy was making like millions and millions of dollars a year building sandcastles. It doesn't matter what you do. If you strive for excellence in what you do, and if you try and you get to the top of your field, there's no reason it wouldn't be an amazing business. But obviously, I haven't seen your business plan, and I have no idea of what your angle is going to be. And it could also be a terrible idea. So take it with a pinch of salt. But like, one thing I'd always say is follow your dreams, man. If this is something that you're driven to do, then you must do it. Can you repeat the rand dollar range you mentioned earlier, where people decide to bring money into South Africa and take it out? Yeah. So at the moment, it's really clear. And ranges change. Ranges change all the time. And this is not a technical range. So I haven't done like a tech workup on the range at the moment. So, we can go and do like full technicals on, we do it for clients quite often. We're about to launch a proper FX note for clients as well, which you'll see added to the website soon, which we will make available to everyone. But like I'm just saying anecdotally, where our desk is feeling it is about 17.30 on the top side. That's where we're running our steam. As soon as we get above 17 Rand to the dollar, the flows dries up. No one is buying, like in our experience, everyone is looking at this. No one is buying dollars above 17 at the moment. 17 to 17.30 is like a dead zone. Like we get no trade flow coming through. 17.30, then we start getting the reverse trade flow. 17.30, 17.40, we start getting reverse trade flow. But again, like it depends on the market action at the time. Then the bottom of that range is, I'd say 16.40 to 16.50. But that's where we're starting to see a lot of dollars flowing out. There's definitely an underpin there. I don't see the Rand going to sort of like 16 flat without a big change in the underlying market. So yeah, it's interesting because like also like it's the same as when we were downgraded. So when we got our move to junk, we had the range broke obviously there, and I mean then suddenly like we couldn't beg people to take money out at 16.50. We were like, hey guys, like this looks like a good level. Let's say we got that downgrade, and this was in the coronavirus spike. I mean, we had guys phoning us at 18 Rand to the dollar. Please take everything. We need it out. We need it out. It's going to 1 million, and you're just like, guy, relax. But it happens there. It happens at that level. Like, so if that range breaks one way or the other, so it'll be weird. Everyone will be taking at 16.40, and that will be kind of where the level is. And then suddenly we'll go to 15.90 and no one will want to take. If it goes to 15.90, like our currency transfers will dry up again, because then everyone's like, oh, new range, could go to 14. And then they'll wait for the range to reestablish, and then we'll start getting order flow again. And the same works in reverse. Like 17.30 is kind of the level. If we get to 17.80, we'll start seeing currency flow again, because people will be like, it's going to 20, it's going to 20. And you'll get kind of the panic sellers moving cash as well. Cool. But that I think that's the end of the questions. Sorry, I've kept you guys a lot longer, another half an hour. But yeah, I hope that was useful for you.
Right. Thank you so much, Gary, for joining us. Firstly, you stayed longer than you were supposed to. So that means a lot to us, because you actually covered so much content that we didn't think you'd cover. So, we really appreciate that on our side. And also, I actually still have a lot of questions for you, but looking at the time, I think it would be unfair to still keep you at the office. So I think...
My wife's going to get upset.
Sorry?
I don't know. I was to say my wife's going to get upset. So.
Yeah, so what we can do is maybe at some points when things get back to normal, we can try to organize another event on campus, actually. So I think that would be really awesome. So yeah, with that being said, Gary, your time is really appreciated. We really thank you for your input that you've shared with us. I always discuss this with my friends, that investments is not just about investing into companies, but also there's a lot of principles that you learn in investing, and the whole process of learning the market. And I think you've really put a lot of insights into that part of our lives. And I think we're going to be able to take whatever you've taught us and implement it into our own lives, and better ourselves that way. So thank you so much for that, and all the best with everything that you have in plan.
Oh, yeah, happy to help. And also, guys, yeah, so like when coronavirus does, so if you do want to also arrange it, so like I said, we've got a beautiful JSE building here, and I know the guys like we do events quite regularly. So if you do want to like host something where you guys do want to come through and see the exchange and all of that, we're also happy to do that. So we must just stay in touch. We set up a time. We've got beautiful boardrooms and stuff that you guys can come to sit in. And I'm sure the guys on the desk would be happy to do another presentation for you.
Right. Thank you so much, Gary.
Cool.
Enjoy the rest of
All right. Enjoy your evening, guys. Thanks a lot for your time.